Hello, friends. I am Mansi Bapna, Assistant Professor, Lakshmichan Gulwala College of Commerce and Economics. Today, we are going to be learning about commodity derivatives. In this video, I'll take you through a brief introduction about it. Assume that you are a stock market trader and have been trading in the futures and options regularly. In the recent past, the commodity market has also shown a tremendous growth in terms of volume, with prices of many commodities hitting either the all-time high or the multi-year high, thereby creating enthusiasm among the traders. Therefore, you too decide to start trading in the commodities. But before starting to invest in the commodities, it is of utmost importance to know about the basics. There are a variety of investment options to help you invest your money and earn the best possible returns with the least amount of risk. Asset classes are broad categories that include but are not limited to cash and cash equivalents. Today, the asset categories have expanded to the bonds, the derivatives, the equities, the real estate, the gold, the commodities, mutual funds, and other alternative investments. Commodity trading has progressed through the centuries, from the barter system to the spot markets to the derivative markets. Goods were transferred between two parties with complementary and opposing needs in the barter system. With the introduction of money as a medium of exchange, commodity trade underwent a shift, and with the worth of commodities being stated in the monetary terms and trading being primarily undertaken through the medium of currency. You may be under the impression that commodity trading started in recent years, but that is not the case. Commodity futures began in Japan with the Osaka Rice Exchange establishing the first known regulated futures market in the year 1730. In the year 1848 and 1877, the Chicago Board of Trade in the United States and the London Metal Exchange in the United Kingdom, respectively, commenced its operations. In the following decades, many more commodity exchanges were established in the nations around the world, including Argentina, China, Egypt, Russia, Turkey, as well as India. Commodity exchanges began to spring up all over the world after the year 1990s. Thanks to the market deregulation and the phenomenal expansion in the information technology. In India, the Bombay Cotton Trade Association Limited pioneered structured commodity derivatives trading in the year 1875 with cotton, followed by Gujarati Vyapari Mandali with castor seeds, groundnuts, and cotton trade. Speculation, stockpiling, wars, and natural disasters have all resulted in temporary restrictions on the trading of specific commodities. Structured, regulated, national level of commodity exchanges were formed with the introduction of MCX and NCDEX in the year 2003. Within commodities, there are three types of markets. First one is the spot forward, second one, futures and options. In the spot market, the exchange of goods happen between the buyers and the sellers instantly. However, this exchange of goods in the spot market was not a requirement for a couple of participants because they were keener on locking the prices for the future exchange of the goods rather than exchanging them today. Hence, these buyers and sellers started entering into the agreements to exchange the goods at a future date for a price decided on an agreement date. This is called as forward contracts. Let's understand this in detail with the help of an example. When a jeweler wants to purchase 1 kg of gold after 2 months, but he is uncertain about the price change of the metal after 2 months. If the price of gold rises, then the jeweler will end up buying gold at a higher price. In order to protect himself from the price risk, he enters into an agreement with the gold refiner to purchase 1 kg of gold after 2 months at a price fixed on the agreement date. That is a price which is fixed today, the quantity is fixed today, and the settlement date is also fixed today. All these basic parameters are decided today, where you are going to be executing it actually after the 2 months, that is at the expiry of the contract period. In terms of agreement, in this forward contract are mutually agreed upon between the refiner and the jeweler, that is, the seller and the buyer. There is always a counterparty default risk when the price is not favorable to either. If the gold price rises above the contracted price, the seller, that is the refiner in our case, may want to default to honor the agreement and vice versa. Since these agreements are entered on mutual consent, there is no guarantee of the agreement being honored if the price is not favorable to the contracted parties. Now, this is a major risk for both the parties. To overcome this default risk, forward contracts are modified into future contracts, wherein the commodity exchange designs the terms of the trade. These exchanges also assure the exchange of the goods upon the expiry of the contract. So somehow, what happens over here is that the commodity exchange acts as a medium between both the parties, and they are going to be acting as a barometer or as a medium of exchange between the parties. The commodity derivatives include commodity futures. These commodity futures are financial contracts which enable you to either buy or sell an underlying commodity on or before a future date at a price which is agreed upon today, and to transfer the risk to the other party as well as hedge against the diverse price movements. To enter into a futures contract through an exchange, you are required to deposit a small portion of the amount, such as a margin, with the exchange through a registered broker. The commodity options give the holder the right but not the obligation to buy or sell the commodities at a specified price and within a specified time. After taking over the regulation of the commodity market from the Forward Markets Commission, the Securities and Exchange Board of India has allowed options trading in the commodity futures as well as on goods. However, the options on goods are not liquid. As an option buyer, you are paying the premium. As an option seller, you are paying a margin. In India, commodity trading has been in existence in the late 19th century. However, trading was suspended after independence due to various reasons. Organized, regulated, national level commodity exchanges subsequently came into existence from the year 2003 onwards with the incorporation of Multi Commodity Exchange of India, that is MCX, and National Commodity and Derivatives Exchange Limited, that is NCDEX. After the unification of financial markets, National Stock Exchange and Bombay Stock Exchange have also started offering commodity derivatives on their respective platforms. Now, let us summarize whatever we have learned today. Commodities are part of an asset class along with equities, currencies, and bonds. National level online commodity trading started in India in the year 2003. Commodities are available for trading are categorized into bullion, energy, base metals, and agricultural. Major commodity exchanges in India are Multi Commodity Exchange of India, National Commodity and Derivatives Exchange Limited, and Indian Commodity Exchange. The National Stock Exchange and the Bombay Stock Exchange also offer commodity trading. Securities and Exchange Board of India, that is SEBI, is the regulator of commodity derivatives market with effect from 28th of September 2015 after the merger of the previous regulator Forward Markets Commission into it. So this was all about the commodity derivatives. In the further lectures, we are going to be learning about the in-depth about these commodity derivatives. Thank you so much. Have a great day.